The market took a hit yesterday, but this was completely directed towards the consumer spending, which primarily is made up of Walmart, Target, Home Depot, and Lowe's. Now, all these companies had their earning release for quarter one, but a major issue might be the decline in consumer spending for the future outlook. Now, I'm going to take a quick look into the finances of these four companies. I'm going to use stockanalysis.com. So first, I'm going to look up Walmart. All right, so looking at Walmart, its year to date is down around 15%. That's including this last shock that it had this week. But their PE is 25, which is a little high for something that's supposed to be considered a value stock. And if we take a look at their finances, the company's revenue has been decreasing. It had a little pop during the COVID time, and their quarterly revenue growth hasn't been this low since 2016. But a major issue that Walmart's going to have is something like their profit margin. So for retail stores, profit margins are actually thin. Walmart's had a profit margin average around 2%. Now let's compare Walmart to Target. Now compared to Walmart, Target's trading a lot worse, with its year-to-date down 31% after this quick drop. But its PE is actually a lot better at 11 compared to Walmart's 25. Now let's take a look at its finances. So looking at Target's yearly statements, their year over year was pretty flat until 2020, which they had a massive spike leading into COVID. But if you look at Target's profit margin compared to Walmart, it's nearly doubled. Now if you take a look at Home Depot and Lowe's, both of these stocks trade relatively the same, but a major difference between them and the retail stores is their profit margin. Both of these companies have a higher profit margin than Walmart and Target. So the profit margin for Home Depot averages around 9 to 10% over the past 10 years. But for Lowe's, their profit margin actually before 2020 averaged around 3 to 4%. And once 2020 hit, they were able to get a profit margin averaging 7% for the past 2 years. Now looking at their balance sheet, you're able to see how each company was managed into COVID and during COVID. But retail stores and home improvement stores will be hit completely different. So for retail stores, you'll see a lot of their operating expenses coming from labor and their increased supply orders that they had from COVID. Compare that to Home Depot and Lowe's, where their increase comes from the cost of materials. So Business Insider has a few articles and where they break down what consumers are spending their money on in each store. So for Walmart, they talked about how shopping is primarily done for the in-store groceries. So all the extras in the store aren't a priority. Compare that to Target, where the sales are roughly equal across 5 categories: apparel and accessories, food and beverages, home and furnishing, and beauty and household essentials. And for home improvement stores like Home Depot and Lowe's, their 2 core groups are DIYers and pro consumers. So as long as something needs to be fixed or built, they'll have a user base. Now the future outlook doesn't look good for retail stores when they're predicting a decrease in spending from consumers. But in times like this, you can expect retail stores to try and make up for that lost revenue. This can be anything from raising prices, cutting jobs, store closures. You can imagine that all of these discussions are being had in boardrooms right now. And while the word recession gets thrown out a lot, in hindsight, these declines should have been expected. But prices are increasing everywhere. Now there's too many areas of where you could point the blame. It could be war, it could be COVID supply chains, it could be inflation. But people are feeling the pressure of increased prices. The Fed rates have been increasing, gas prices increasing, food prices. Inflation is currently over 8%. That's the highest it's been in over 40 years. But if you're looking to calculate the true value of any of these companies, any tool that follows basic fundamentals like revenue and profit tell you that a majority of these companies are all overpriced. Now that's not to say that these aren't good companies, they're just all overpriced in a current market that's trying to find the balance between value and growth. But to look back on how these companies were fared in the '08 crash, retail was hit completely different from home improvement. For Walmart, as an example, it took over 3.5 years for it to break back to its all-time highs. And for Home Depot, it took just over a year and a half. Now that's just to prove each area in the market will be affected differently depending on how they move forward. Now for home improvement stores, a major area of concern will be the cost of material and supplies. But recently Home Depot announced that they are expecting an increased revenue for the year of up to 3% in expected sales. But for retail stores, if they don't find a way to increase their profit margin based on their goods, people may just take their money and find shelter in a different area. But let me know if you have any plays down in the comments. And if this video helped you out in any way, don't forget to like or subscribe so I can continue making content just like this.